Hello, everyone, and welcome to Overbond's National Issuer Conference Call. My name is Eric Buckingham, Director of Sales at Overbond. I'll be officiating today's call. With me today, we have Tony Sebchek, Head of Sales, who will be speaking to the topics at hand and answering questions during the Q&A portion of our call to happen towards the end of our scheduled time.
Hello, everyone.
Tony, before we begin, could you introduce yourself and your background in capital markets, please?
Yeah, sure, Eric. I have over 23 years experience in capital markets and alternative investments. Prior to joining the Overbond team, I was a managing director at BMO Capital Markets before heading over to become head of sales, fixed sales for Bank of America Merrill Lynch, and head of sales for Dundee Global Investment Management.
Thanks, Tony. Before we get started, let's go to the agenda for today's call. To begin with, we're going to discuss the financial technology environment and trends we saw in 2016. Next, we're going to go over the occurrences in debt capital markets for 2016 and what we can expect in the upcoming year. Finally, we're going to discuss the role of technology in growth initiatives and regulatory considerations. So, Tony, let's start with something you and I are both familiar with, financial technology. Tell us about the landscape and some notable facts from 2016.
Yeah, sure, Eric. The momentum surrounding financial technology is incredibly strong. In 2015, investment in financial technologies hit $19 billion, and we are already on track to surpass that this year. In capital markets specifically, the theme surrounding this movement is collaboration. Collaboration with all parties involved to evolve the market ecosystem.
Great. It's no secret that capital markets has been resistant to change, especially involving financial technologies. What do you have to say about that?
Well, Eric, the world is changing, and capital markets will need to change with it. Ernst & Young actually stated this year that innovation within capital markets is no longer optional. Investment banks are faced with high structural costs, heavy capital changes, and stagnant returns. They have been focused on delivering changes mandated by regulators and external threats. These regulatory deadlines are exhaustive to meet and result in a lack of focus on investing in initiatives to ultimately build innovative ways to serve clients. These same financial service providers are working with financial technology companies around the world to act to supplement this. This is the very reason financial technology growth has occurred so rapidly, and we can be assured that capital markets will be no stranger to this.
Excellent. Moving on to debt capital market trends, could you walk us through some themes we encountered in 2016 and what this means for the rest of this year?
Yes, this year we saw four main themes pertaining to debt capital markets. Let's start with fixed income markets. We saw two things occur in 2016, policy-driven market volatility and widening policy divergence. In terms of policy-driven market volatility, we saw record low bond yields in the UK in the wake of Brexit, sending global bond yields to record lows. However, since Trump's election victory in the US, inflationary expectations have been moving surgically higher, leading to a sell-off in US long bonds and rally in broad equity markets. In terms of widening policy divergence, we are seeing discrepancies between the US and the rest of the developed markets, especially in Europe. Whereas ECB is likely to extend its Euro 80 billion a month bond repurchase program, the Fed in the US is poised to hike its interest rate in December. The two diverge at a time when their economies are at opposite ends of the spectrum. While the Eurozone struggles with high unemployment, weak inflation, and near flat growth, the US economy has seen remarkable strength. That will leave Yellen no choice but to move the US to higher interest rates. Relating this back to home, like Europe, Canada is unlikely to follow in the Fed's footsteps anytime soon.
Great, Tony. And what can we expect in the year ahead?
Well, Eric, with bond yields reaching record lows this year, it can be expected that global interest rates will continue to be low, driven by continued easing from the ECB and the Bank of Japan. In addition, growth prospects and lower for longer inflation in the Eurozone, Japan, and the UK, and to some extent in the US, indicate an unsupportive backdrop for higher interest rates globally. For example, in 2016, we saw companies like Unilever and Toyota issue near 0% yields. Further, average corporate bond yields in Japan were reported at 0.17%, down from 0.33% a year earlier. Another big theme this year was robust bond issuance. Corporate bond issuance will remain robust, but may contract marginally unless other factors like M&A come into play. Government bond issuance is likely to pick up the slack as many governments will continue to take advantage of the low interest rate environment. For example, Canadians are seeing our Prime Minister Justin Trudeau committed to a highly accommodative fiscal policy that includes large infrastructure spending financed primarily through the issuance of debt. In the US, the Trump administration is also supportive of increasing infrastructure spending, which in turn will result in debt issuance ranging from municipals to US treasuries.
All right. And what are some factors we should watch out for in terms of this?
Well, in 2017, the rising rate environment in the US and dovish stance from the Bank of Canada will potentially attract more Canadian corporate issuers who used to more frequently come to the US bond market to issue in Canada market instead. Also, Canadian issuers with heavy US operations might choose to issue Canadian bonds as well and then swap them back to US dollars. Additionally, Trudeau's and Trump's plans to increase infrastructure spending may lead to a surge in infrastructure sector bond issuance in 2017 and beyond. Finally, oil prices are likely to pick up as well, creating opportunistic credit conditions for those in that market. Eric, let's explore technology even further now, as many of our listeners today want to know how technology can help them in their jobs. So let's specifically address the first issue. How can technology help build stronger relationships with market participants?
Good question, Tony. So as an issuer, the top relationships that you have are with the investor and the dealer. In addition to that, of course, you've got relationships with your internal stakeholders and external relationships with credit reporting agencies, market data providers, and legal firms. For the investor relationship, we're primarily helping you diversify the investor base. We're providing predictive algorithms to analyze the existing investor base to identify potential new investors and recommend outreach points so that we can look at things like investors' mandates, existing holdings, market conditions. We also have an investor scorecard where we basically take quantifiable investor relationship and calculate metrics, including historical deal participation, amount of reverse inquiries, board seats, equity holdings, chat history, stuff like that. At the dealer level, we're simplifying treasury operations. So recommending syndicate and dealer member roles, syndicate position for future offerings. We're optimizing DCM and syndication, new issue pricing coverage. We're suggesting regular communication with the dealer network. We're also monitoring dealer KPIs. So we're giving you a comprehensive review of dealer coverage by analyzing multiple KPIs, including things like historical order book, contribution, existing bond, secondary trading, sales and research coverage, lending relationship, etc. We could also leverage inputs from communication volume through all the different channels like email, chat, the existence of certain exchange or exchange online calendar events, and using that to quantify the quality of the relationship. Internal stakeholders. So we're actually helping to enable cross-functional collaboration across the stakeholder teams. And we're doing that securely. So documentation, sharing of information across the different platforms, internal treasury team collaboration and integration with the finance and accounting teams. Those are just some of the different counterparties that would be involved in internally. External relationship management, so 360-degree stakeholder relationships. So we're providing a customized relationship management module for all the stakeholders involved. So things like communication with the regulator, legal counsel, credit rating agencies, and market data providers. We're also helping to optimize the borrowing program. So we're helping issuers de-risk future offerings and reduce the cost of financing. So lowering the cost of debt for the issuer. We're doing that in a few ways. So the first is predictive analytics. So we're suggesting relevant investor and dealer touch points. All right. We're providing a profile of potential investors and fixed income market sentiment indicators so that you can time your deals properly. The second is digital demand discovery. So we're allowing you to identify demand discovery through real-time online communication with market participants. We allow you to receive expressions of interest via multiple channels and instantly convert them into offers. We also have a powerful pricing hub where you can get real-time direct feeds from the dealers, manage new issue pricing information in one place that's easy to tabulate, store, and export. You could also request updated pricing from the dealers and plot historical levels. And this is a lot easier than the way that most of our issuers are doing this today. Every Monday morning, they're getting a spreadsheet or a PDF from their dealers, and they're manually merging this into a master spreadsheet. With our platform, we're leveraging some integration technology with OCR to automatically import these spreadsheets or these PDFs into our central platform so that we can keep this dealer provided information in one central place without any human being in the middle doing spreadsheet jockeying, right? As a primary bond issuer, Overbond is going to provide you with a sector credit spread index based on information that we're gathering from reverse inquiries submitted by investors. We've also got a new issue pricing tool that sits alongside market intelligence from dealers and data providers like Thomson Reuters. Tony, regulatory compliance is a great consideration for all players in the financial services landscape. Can you touch on some of the challenges that are being faced by practitioners in the marketplace?
Yeah, sure, Eric. In today's landscape, more stringent and changing regulatory environment makes it important to ensure that capital market participants are equipped to meet the requirements. Data availability and record keeping through technology is a strong theme for all leading capital market participants. In terms of challenging regulatory requirements, we are seeing three core difficulties. First, financial regulation has become increasingly demanding post-global financial crisis. Additionally, regulators are placing a strong emphasis on risk reporting challenges banks' current compliance framework. Finally, financial institutions are challenged to comply with fast-changing requirements from various regulators in multiple jurisdictions.
Excellent. Are there any other challenges within regulatory compliance that financial services is currently facing?
Absolutely, Eric. More specifically, the aforementioned challenges result in a more complex reporting process. First, distributed, internal, and legacy IT systems complicate reporting processes and increase compliance risk. This poses a major efficiency and accuracy challenge as most financial institutions still heavily rely on manual processes to manage, analyze, and prepare data.
Tony, are there any other challenges within regulatory compliance that financial services is currently facing?
Absolutely, Eric. More specifically, the aforementioned challenges result in a more complex reporting process. First, distributed, internal, and legacy IT systems complicate the reporting process and increase compliance risk. This poses a major efficiency and accuracy challenge, and most financial institutions still heavily rely on a manual process to manage, analyze, and prepare data. To further exacerbate this issue, exponential growth in financial products and transaction data further complicates the situation. To build on this, there are now increasing compliance costs involved in increased regulatory measures. On average, large global financial institutions spend over $1 billion annually in compliance, a considerable expense for most companies. The consequences from improper regulation management have been quite costly for companies worldwide. Regulatory fines and settlements in 20 large US and European banks increased by 45 times from 2010 to 2014, according to McKinsey's 2016 report on best practices in bank compliance. In 2016 alone, Deutsche Bank faced a $14 billion fine for misleading bonds during the financial crisis.
So how might an issuer deal with compliance issues?
Well, Eric, this goes back to our discussion on technology integration. Compliance costs and risk can be managed through adoption of a digital record-keeping platform. By integrating technologies, including what we offer in the Overbond platform, you can find solutions that actually enhance regulatory functions, and here is how. Using Overbond as an example, that is something both you and I are both familiar with, we see reduced compliance costs. Reporting is standardized by being able to map compliance tasks to relevant business units according to their fixed income market activities. You also have better risk control. Enterprise governance frameworks are now applied to your internal standardized process and data solutions. Also, you're now seeing actionable regulatory intelligence through the use of advanced data analytics, regulatory risks and issues are now able to be identified proactively.
Thank you, Tony, for those very helpful insights. Let's move over to the Q&A portion of our call. Do we have any questions? Okay, our first question is, who uses Overbond, and is Overbond a dealer? Good questions. So the top users of Overbond are issuers, dealers, and investors. So we work with both corporate and government bond issuers, small, medium, and large dealers, including global dealers, and bond investors. In terms of third parties, we work with credit rating agencies and regulators, of course. Overbond is a fixed income financial technology enabler that streamlines all stages of the bond origination process. So we are not a dealer at this point. We're not regulated. Okay, our second question is, what kind of fixed income securities does the Overbond platform support? So today the platform supports corporate investment grade bonds, corporate high yield bonds, maple bonds, international bonds, convertible debts, green bonds, asset-backed securities, and peer-to-peer lending portfolios, and more. We're constantly adding additional bond types to our platform, to our network. Okay, our third question is about the security features of the Overbond network. Great question. Overbond's infrastructure relies on bank-grade security and encryption. The network uses a secure Amazon cloud-based technology with industry-recognized certifications and audits. All the data generated through the application is encrypted using industry-leading techniques. Okay, that's all the time we have for questions today. If you do have additional questions, of course, they're always welcome. You can email our dedicated support team at info@overbond.com, and a support professional will get back to you within 24 hours. Tony, thanks for joining us today, and everybody have a great day. Thank you.